I think that we're living in an environment in which, if you look at what is happening in Japan, what is happening in the UK, France, Germany, is that developed economies are in secular stagnation. So we're in a sort of perennial type of crisis on a macro level that certainly gets even worse at a micro level when we talk about disposable income, real wage growth, etc. However, precisely because of that and because of the aggressive level of indebtedness that these countries are entering into and have entered into, uh, precisely because of the enormous level of debt and the policy of central banks, which basically try to say to everyone that they're very prudent, but they're actually very accommodative. So we're actually in a bull market, secular bull market, with in what I call private sector recession.
Yeah, it's so interesting. I want to get to the more macro, but I mean, speaking of Japan, I was watching this morning, they just got that small upgrade from the IMF. The growth nudged to about 1.1%, but it's still fighting that stagnation it's faced for 3 decades, you said. I mean, inflation is finally above that 2%, but debt is over 230% of GDP, and demographics, as you know, keep dragging the economy down. Is Japan kind of showing what the rest of the world is sliding towards, this high debt, low growth, and no real way out?
Yeah, Japan comes from the future. Japan is doing exactly what France, Germany, the UK did in the past, and Japan is many years ahead of those nations in terms of the enormous level of government spending. You see, when governments try to disguise structural challenges like demographics with government spending, it always fires back. It always has a negative effect. And the negative effect is very evident in Japan. Trying to disguise the structural challenges of the economy with elevated government spending, enormous levels of debt, and so-called public sector stimulus have generated absolutely zero level of productivity growth and certainly that problem of stagnation. Obviously, the bill comes in a very elevated level of debt, and now the prime minister is promising to try to curb the inflationary pressures with more money printing. So that is obviously fascinating to watch, because this is another Keynesian failed experiment. And unfortunately, what Japan is going through these days is what France, the UK, and Germany are likely to see in a few years.
Yeah, let's bring it a little bit closer to Washington. I mean, it's obviously the news that's driving this market panic. The Washington Post is calling China's move on rare earths its trump card. Secretary Scott Bessent accused Beijing of kind of pointing a bazooka at the supply chains of the entire free world. Now, is this just another trade spat for the headlines that we read about in the mainstream, or are we kind of watching the beginning of another full-blown economic war that makes a global recession a certainty?
I don't think that we're living in a full-blown economic war. What we're living is a negotiation in real time. We're watching two very big global leaders negotiate in media headlines. That's obviously creating some market volatility. But ultimately, the reason why we're not going to enter into a full-blown trade war between China and the United States is because China cannot afford it. China has an enormous problem of overcapacity, a very challenging domestic demand, and the exporting sector in China simply cannot look at other opportunities in other markets. The problem not just of overcapacity, but of working capital of many of these exporters is enormous. So China needs the United States, needs the US market. The idea that China would offset its lack of sales to the US with other markets simply didn't happen, and it was obviously a completely misguided idea, and therefore both need to reach an agreement. And I think that the reason why the Trump administration has immediately called for higher tariffs is precisely to push for that negotiation and to reach a deal that is positive for both. I think that that is what will happen. And I think that markets with a very subdued move are also discounting that outcome.
Yeah, well said. Let's talk about China just for a quick second here, because obviously you just said that they can't afford any more problems and the economy is already kind of a mess. I mean, we're seeing this play out. Property prices still falling, youth unemployment near 15%, capital flight accelerating, and now this trade confrontation with Washington. I mean, how fragile is China really right now? Is this a controlled slowdown, or are we looking at a system on the verge of losing credibility?
Well, lots of problems in the Chinese economy, and all of them coming from central planning. Guess yet again. But once we look beyond the real estate challenge, which is enormous, obviously, and you've pointed out very well that it's nowhere close to be solved. The Chinese economy, in terms of technology, in terms of other sectors, is actually doing better than what many expected. No, but certainly there's an enormous problem of domestic demand. The Chinese economy simply cannot offset its exporting activity with domestic demand because wages are very low. And obviously there is an enormous problem of youth unemployment and an enormous problem of internal poverty. So all those elements are challenges, but the Chinese economy is very robust in other areas, and that will allow it to deliver a level of economic growth that, being disappointing, is certainly not one of recession. But we are living in real time the burst of the biggest real estate bubble in history.
Yeah, and they're doing it in real time. I mean, Beijing's official data still shows steady growth and record gold imports, but foreign investors keep pulling out, and the yuan remains under pressure here. I mean, in this fragile state that China is you and I kind of talk about, if that's the case, what's the global implication here? Does the rest of the world import deflation, or does Beijing respond with another round of stimulus that reignites inflation everywhere else?
It's a very good question. I think that the government in China is aware that a lot of their problems come from the stimulus packages of 2008 to 2015. So if they follow on with building stuff just for GDP purposes, then they will get in a worse problem than Japan is in right now. So it's a very challenging situation. On the one hand, China needs to export its way out of its internal challenges, and that obviously raises concerns, particularly in the European Union, about receiving a flood of very, very cheap products that may distort prices and the activity in its industrial and manufacturing sectors. So all of that is a big challenge. I think that the problem is that China needs to realize that a real estate bubble of the magnitude of the one that they have is not going to be solved by building bridges and spending in more infrastructure, which is already a problem of overcapacity that the Chinese economy has. So I think that they will basically try to export their way out. That is certainly generating a lot of concerns in the European Union in particular.
Yeah, and of course we're seeing it play out in the precious metal side too. Let's talk about that new term that we're all using, this debasement trade. I mean, Daniel, for years, as you know, on this channel, on Kitco News, we've been covering the currency debasement story while the mainstream has ignored it. I mean, now with gold trading above 4,100, it seems to be finally catching up. Bloomberg even coining a term for it, that great debasement debate, as we said. Now, you posted on X that gold and silver are discounting currency destruction. Is this the moment the world is finally losing faith in paper money? Is it more than just a safe haven trade, more of the structural thing we've been talking about in the past?
Absolutely. You're absolutely right. You have been reporting about this for a very long time, and people are starting to catch up to the reality that this enormous level of debt accumulated in sovereign issuers and the unfunded liabilities, which means more debt in the future, added to the extraordinarily aggressive public sector stimulus packages that have delivered no growth. All those things have generated a very negative cocktail, which is that central banks all over the world have abandoned sovereign debt from developed nations as the reserve asset that provides stability and economic real return. So what has ended up happening is that governments like the Japanese, the UK, the French, also even the United States one, that thought that they could print their way out of any problem by sending their enormous levels of debt to other countries as a reserve asset. That idea has gone, no? And therefore, the currency purchasing power destruction, the debasement trade is in full swing. But gold and silver are only discounting a small proportion of the enormous iceberg of unfunded liabilities that so many of these nations have committed to.
Yeah, yeah. Well, I mean, I'm watching Powell as the time that we're recording this, making sure that we're up to date as he kind of talks over at that NABE conference in Philadelphia. And, pointing to your point here, Daniel, and yet you've also pointed out this great paradox, right? I mean, the US dollar index is strong. It's holding above 99. I mean, you attributed this weakness in Europe and what you called the yen sacrifice in Japan. If the U.S. is drowning in over $36 trillion of its own debt, why is the dollar strengthening? I mean, how long can the dollar be the cleanest shirt, the cleanest shirt in the dirty laundry, as we like to call it? And what is that tripwire that finally breaks global confidence in the world's reserve currency?
Well, the fact at the end of the day is that the monetary world is a world of relatives. So the dollar is not stronger, is that the yen and the euro are weaker, in particular those two, also the pound, no? So you've mentioned a very good term, no, which is the cleanest shirt in a dirty laundry, is that the dollar is going to continue to be the world fiat reserve currency as long as all other fiat reserve currencies are actually behaving in a much worse way. And that means that the governments that issue those currencies are actually entering into worse fiscal and monetary imbalances. And a lot of people point, and rightly so, to the enormous debt of the United States. But what very few people talk about is what I have mentioned twice in our conversation, which is the enormity of the unfunded liabilities committed by governments like the UK one, the French one, the German one, or the Japanese one. We're talking about 500%, 400% of GDP, significantly 2-3 times higher than the unfunded liabilities of the United States. So all of that points to, yes, it is true that the US dollar is losing purchasing power, and that's why gold continues to rise, but it is losing purchasing power at a slower pace than Japan, France, or the UK. Every time that people talk about government spending, government stimulus packages, and that increasing debt is not a problem, increasing public debt is not a problem because it doesn't generate any challenge. Well, it does generate this challenge. Your salary and your deposit savings are losing purchasing power, and fast.
Yeah, it's such an interesting story. I mean, we could go so many places. Powell was making these comments this morning against this backdrop of the fiscal reality that's getting harder to ignore. I mean, we got the $37 trillion in debt. And if you include those unfunded liabilities, Social Security, Medicare, federal pensions, some estimate that to be north of $200 trillion. So to your point, I mean, at what point does this become the real driver of monetary policy? Not inflation, not employment, but sheer enormity of these obligations.
Oh, I think that it is already in disguise the main driver of monetary policy. The reason why central banks have been so accommodative in an environment of persistent inflation, the reason why central banks continue to inject liquidity, which is printing money, is precisely because they need to do all they can to maintain the sovereign debt bubble alive. And if you think about it, when central banks are being so vague about inflation targets and so vague about the job market targets, at the end of the day, if you look at what they are really doing relative to what is happening globally, central banks in the UK, in the European Central Bank, Bank of Japan, or the Fed, all of them have one priority, is that governments continue to finance their increase in debt in the most sort of acceptable way. They accept that they will have to suffer higher yields, or at least elevated yields relative to what they would like, but they also know that there is no other option. At the end of the day, when central banks talk about injecting liquidity, what they're doing is actually monetizing debt.
Yeah, yeah. I mean, because if the Fed has to keep rates low just to make that debt serviceable, then this isn't about fine tuning policy anymore. It's about managing insolvency through inflation. So, is that what you mean when you talk about the slow motion implosion of advanced economies?
Absolutely. That is
Yeah,
exactly what it is.
yeah,
It is
yeah.
that a lot of people think that inflation is some sort of fatality, some sort of surprise. No, inflation is a policy. Inflation is the destruction of the purchasing power of the currency. The currency is sovereign debt, and sovereign debt is losing value and is losing purchasing power in the currency in which it is issued, and the yield that markets demand for that sovereign debt is a manifestation of a de facto default.
Hmm.
So it's a slow motion impoverishment through the debasement of currency. That's why gold, silver, and equity markets as well are functioning as a defense against that debasement.
Yeah, well said. I want to ask you, I mean, we got to get into gold and silver, obviously, for our audience, but let's turn to the Federal Reserve just quickly, because again, I'm watching Jerome Powell do his speech right now in front of the NAB conference, or the NABE in Philadelphia, and his tone was noticeably defensive. I mean, he warned that if the Fed moves too slowly, the U.S. could face painful job losses, of course. And he also said that the central bank may end its balance sheet runoff within months, essentially pausing quantitative tightening while acknowledging this pretty significant downside risks in the labor market and potential tariff-related inflations. Powell admitted that with hindsight, the Fed could have and perhaps should have ended its pandemic era bond buying earlier. It's a rare admission from Powell. Daniel, is Powell signaling that the Fed is losing control of its own exit strategy, that policy is now cornered between a weakening job market and a government drowning in debt?
I think you're absolutely right. I think that what he is basically saying is precisely that. And he's also admitting that the Fed has been atrociously wrong about inflation, atrociously wrong about the job market, and atrociously wrong as well about the path of increasing and tightening monetary policy. Basically, we're talking about too late, too slow, and too wrong in every single aspect of the Federal Reserve's policy. They were too late at tightening when inflation ran out of control because of excessive fiscal and monetary policy. They after creating elevated inflation, they actually passed a significant burden to small and medium enterprises and families by raising rates way too fast, and then they cut rates way too early, and now they kept rates for too long based on a narrative of inflation that was completely wrong. So in essence, since for a very long time, actually, you can say that the Fed has been completely wrong about almost every single one of their predictions.
Yeah, well, it's nice. I mean, because if ending QT is the first step towards easing, isn't that effectively monetizing the deficit under a new name? Kind of confirming what you've already warned about, this fiscal dominance, not monetary prudence, now drives the Fed.
Absolutely, it is.
Yeah,
Absolutely, it is. Remember that the Fed already panicked in 2023 by delaying the quantitative tightening program, and it also panicked by increasing liquidity, which is basically purchasing bonds at par from regional banks when the First Republic Bank crisis erupted. No, so all of those things point to a central bank that is trapped between a very high level of debt and a level of persistent inflation that they themselves created. Ultimately, with this, the lesson is very simple. When you decide to launch a quantitative easing program as some sort of magic solution that will give time to governments to balance the budget and be more prudent about fiscal policy, what the central bank is doing in reality is incentivize more debt, which is what happened in 2021. The policy 2020 2021, the policy of the Federal Reserve only gave further ammunition for the government to increase spending by another 2 trillion above the emergency level of COVID.
And that brings us, I guess, directly to the market's response. I mean, gold, as you mentioned, it's surging past $4,100 an ounce on the spot side. Silver past $51. Investors clearly see what Powell won't say out loud, that the age of easy money might be ending on paper, but it doesn't seem like it is on practice. Before we get into gold, I want to ask you what's happening in silver, because the move's been historic. I mean, it's trading above $51 an ounce. That's up more than 70% this year. And to put that into perspective, when silver hit $50 back in 1980, it stayed there for barely 3 hours. That was obviously during the Hunt brothers squeeze in a much smaller global market. But what we're seeing now is something very different, driven by, both the monetary fear that we're talking about, that real industrial demand. Volatility will go both ways, but it seems to be looking like a broader structural shift. Is this, in your view, a true physical squeeze, or is it the start of repricing of silver's role in the global economy?
I think it is the start of the repricing of silver in the global economy. Remember that a lot of people have missed dramatically the gold rally because they thought, oh, it's gone up way too fast. It went to 2,000, to 3,000, to 4,000. And now a lot of them are saying, oh my God, we've missed the gold rally. I don't believe that it's over because of what we have just mentioned, the monetary debasement problem. And what they look is, oh, the ratio of gold to silver has widened so aggressively that the catch-up opportunity is silver. But the long trade on silver has happened just in a year in which supply of silver is very, very tight. So it's created that squeeze that you mentioned. There's also another financial element, is that a lot of people that were worried if gold was rising too fast and they were looking for some sort of hedge. There were a lot of hedge funds that were long gold, short silver as a sort of good market neutral bet. It's not neutral at all, and it's generating some short squeezes right now. So supply is tighter. A lot of people are playing the catch up on gold in the silver trade, and a few hedge funds have had to unwind their shorts on silver.
Yeah, I just want to ask you a little bit about the mechanics of that, because our audience is very interested in the paper versus physical markets. I mean, we're seeing reports of a paper to physical ratio exceeding 350 to 1. I mean, the market is in backwardization, a rare signal of extreme physical tightness. What happens to someone holding a silver ETF or a futures contract if the LBMA or COMEX faces a delivery failure? I mean, is the paper market about to break, or what would that look like for the real price of physical metals in your hand?
Oh, if that market would break, there would certainly be an abrupt decline in the price that would probably be offset afterwards once those contracts are rolled over and it's cleaned up. But obviously, it could create a moment of panic, certainly. I don't think it's going to happen, because what is happening right now is that a lot of financial institutions are creating new instruments that are allowing to provide liquidity to a relatively illiquid, or not as liquid as gold, paper market. So I would pay attention to the opportunities created by changes in the paper price relative to changes in what is happening at the supply and demand side. That points basically to see any type of correction driven by these technicalities to be an opportunity for investors to purchase ETFs for the future.
Okay, so you're still bullish on the trade here, on the silver trade. We still got some room to go.
I think we got some room to go, particularly for what I said before, is that I think that I think it's very difficult for people that have lived in the mirage of quantitative easing is never going to be a problem, and governments can issue all the debt that they want. There was a very short period of time in monetary history. It's very difficult for a lot of people to grasp the idea of the debasement trait that we mentioned, of the evidence that the only way in which a sovereign debt bubble bursts is through the destruction of the purchasing power of the currency. Therefore, it's not that silver is squeezing or that gold is rising or that equity markets are reflecting an economic boom. Is that basically what they're reflecting is the future debasement, the future loss of purchasing power of the currencies in which they trade.
Yeah, interesting. It's been fascinating to watch. And as we mentioned, we've been covering this for years now. So it's interesting to kind of watch it. I mean, on the gold side, the reaction seems to be telling the real story. I mean, we got equities, crypto, all under pressure, gold doing the opposite. It doesn't seem like it's just a hedge trade anymore. Of course, we know central banks are still net buyers. China's demand remains kind of opaque, to say the least. And sovereign funds in the Middle East to Asia have been quietly adding exposure. ETF inflows are kind of hitting those yearly highs after 2 years of outflows, suggesting that institutions are kind of coming back in. I mean, Daniel, you said that gold is no longer a contrarian asset. It's the truth teller of monetary policy. Is this simple flight to safety, or do you think that the market's kind of calling out this credibility, because it doesn't seem to be just reacting to fear anymore? It seems to be reacting to policy failure.
It's reacting to policy failure, absolutely right. And you have been reporting it for a long time, how central banks all over the world were losing confidence in sovereign debt, i.e. reserve assets from developed nations in their balance sheets. These central banks and also the central banks of developed nations have seen that their holdings of sovereign debt were yielding negative real returns, so losses. No, so this comes at a price. And what is happening is basically that what is manifesting is that the historic 60-40 trade in which people would look to have a portfolio of 60% equities, 40% sovereign debt in order to give you a cushion that gives you some real economic return if markets are a little bit volatile, etc. The 40% has gone. And a lot of people are starting to think, hey, instead of having 40% sovereign debt, we need to have at least 20% gold, because that is what would mirror the policy of all of those central banks that have said no more sovereign debt in our asset base.
Yeah, and to your point, I mean, talking about that repricing of silver, skeptics obviously will say that this is just another momentum trade, that once volatility cools and the Fed cuts, gold will fade. But if what we're seeing is structural, I mean, deficit de-dollarization, and now this geopolitical breakdown we're talking, is there any path back to normal, or is this a world now permanently repricing paper money against real assets?
I think that what we're seeing is back to normal, but to fundamental normal, which is that sovereign debt is not a no-risk asset, is that governments are not magical entities that can issue all the debt that they want forever and ever. No? I think that what we're basically facing is the harsh reality that the mirage sold in 2008 about an ever-expanding central bank world that, the so-called alchemists, like the title of the book I have behind me, the so-called alchemists have had found the way to get out of every crisis without any risk. That didn't happen. No, didn't happen. So it's basically just, in essence, we're basically going back to reality instead of a new reality, if that makes any sense.
Yeah, it does. And if we bring it back to the U.S. markets, I mean, you've made the compelling case that the U.S. private sector is strong, defying recession calls. We saw that massive sell-off a little bit earlier. It seems like we're pairing our losses now. But the big question on everyone's mind is this just a buy the dip opportunity? I mean, legendary investor Paul Tudor Jones, I was watching him this morning, and he said that the market feels exactly like 1999. He's positioning for a final kind of explosive blow-off rally before the top. Is he right? I mean, is there still room for this bull market to run, or is the dip buyers walking straight into a trap?
I think that there is still a bull market, a secular bull market created precisely by the combination of misguided policy in the past from central bank, a misguided response right now from governments and sovereign issuers. But I think it's also the strength of the US market is also going to come from the realization from many investors that the call that a lot of people made at the beginning of the year, that you basically had to get out of the US and buy Europe, China, Japan, etc., may still have some legs in the Japanese market because of the Bank of Japan craziness, but that there is a great opportunity in US assets because the level of animosity from international investors toward US assets was completely unjustified, but actually created a great opportunity. No, in what I call the tariff tantrum. In the tariff tantrum, a lot of investors globally made a call to go short US assets, short the US dollar, short US equities, long European ones, and obviously the European economy is not getting any better. No, so I think that still creates an opportunity. I think that the United States stocks still have room to go, particularly because the enormous rally that we have seen has been led by basically 7 stocks. No, so there's plenty of valuation opportunities in the other 493.
Yeah,
From the S&P 500.
You could argue, I mean, you have argued just there, talking about this entire bull market from equities to housing to metals was kind of built on misguided policies, because when you strip away the stimulus, the subsidies and central bank backstops, I mean, what's left for real growth? If the bull market was engineered, does that, kind of mean that we're now entering the payback phase where markets and currencies and governments all have to mark to reality?
I think that is exactly the case, is that the idea that the inflationary pressures were gone and that we had just lived a small problem in 2020 to 2021 has gone. And the evidence of the bond market is staggering. No, the bond market is telling you that you could actually make one analysis or the opposite. You could actually say, well, the bond market is wrong or the equity market is wrong. I think that what right now everybody's starting to understand is that the equity market is reflecting the same as the bond market, which is that Japan, France, Germany, the UK, the US, all of them are going to try to disguise their enormous fiscal problems with monetary debasement.
Yeah, fascinating. We were talking about Paul Tudor Jones there before. He also warned that this will have a, quote, really, really bad end. And now we have JP Morgan's Jamie Dimon this morning warning about cockroaches in the credit market. I mean, you've described a slow, kind of that slow motion implosion, right? How does an investor navigate this? I mean, how do you position for a potential melt up while knowing that there's a cliff right behind it? Is it even possible to time the exit, or is it just kind of that fool's game?
I think it's very difficult to time the exit, and the reason why is because you cannot just predict what central banks are going to do after the enormous excesses that we have seen in the past. So what an investor needs to do is not to ignore reality, obviously, because if you're away from the market, then you're losing money in real terms because of inflation. And the other thing that you cannot do is simply go with the flow and think that nothing is going to happen. No, so you basically have to surf this market. How do you do that? Avoid the sectors that require a stronger economic growth, stronger productivity growth, and the very cyclical sectors are already suffering, but they will continue to suffer. So the losers are not going to catch up with the winners. And the winners, you cannot just stay and think, oh, these valuations are excessive in technology giants, but they're going to continue to be excessive forever. So you need to be, you should not be too complacent on technology giants, and you should not be expecting that the losers, that those hyper cyclical sectors that have been laggards are going to catch up in terms of valuation to the winners. So you have to be prudent, but you have to be in the market. You need to be in the market, because if you're not in the market, you are already taking a bet, which is an enormous bet on revaluation of currencies that is not happening.
Yeah, let's talk about that future of money. I mean, you've argued obviously that gold and Bitcoin are the only things that can stop governments from destroying the currency, playing that role that central banks have abandoned. But I mean, we just saw Bitcoin crash from 126,000 to below 105 in a matter of hours, triggered directly by this U.S. government tariff announcement. Does it prove that even centralized assets are still on a leash, held by sovereign powers, kind of challenging their role as truly independent money?
Well, obviously, when we talk about Bitcoin, we're talking about a teenager. Huh? So we need to understand that this teenager of a currency is going to be significantly more volatile than what other currencies are. No, and it's not even a currency yet. It is what I call startup money. And I think that investors that acknowledge that are not surprised by the volatility in Bitcoin. But if you look at it relative to the low volatility, but only one way decline of the yen relative to the US dollar, well, I think that it's proving that you may get some levels of turmoil in cryptocurrencies. But and that is the reason why when I mentioned prior that the 60-40 portfolio is dead, I did not say put 20% of the portfolio in cryptocurrencies. Maybe put a little, but be aware of these levels of volatility. Ultimately, I think that what is happening is catching up all the time to a market that is slowly building its own liquidity. And Bitcoin obviously suffered in the past because its liquidity was the US dollar. That has changed, but that hasn't changed entirely. No, so I think that there's quite a bit to learn from the growth and the development of this teenager of a decentralized currency.
Teenager. I'm going to use that, Daniel. I mean, obviously you've warned about the ECB's digital euro kind of being that tool for surveillance money. And then in 2025, it's been a breakthrough year for crypto regulation in the US. I mean, we're seeing institutions like BlackRock and JP Morgan now building that infrastructure to tokenize real world assets. Is it being tamed? I mean, you call it a teenager, it's maturing. Is Bitcoin being tamed? Is the crypto space being co-opted by the very system it was meant to disrupt? And can a regulated kind of institutionalized asset still serve as a real check on government power?
I think it can. I think we're just seeing the beginning of institutions dipping their toes into the crypto world, simply because of demand from clients. No, they're basically saying we cannot miss this, and we need to provide something for our clients. But obviously, they have no way of measuring the value of crypto assets relative to anything because they're in a separate world and it's very, very difficult for regulated entities. So I think that basically this is all driven by the demand from clients, and I don't think it's being tamed. I think that it's going to be impossible for Bitcoin and other cryptocurrencies to completely destroy the US dollar or the euro or the yen. I think that crypto assets and fiat currencies are going to live in parallel worlds, and the only thing that sort of glues them is the fact that we talk about them in dollar terms. But if you go to, I don't know, Decentraland, nobody talks about Bitcoin in dollars. They talk a Bitcoin is a Bitcoin. No, so I think that is probably what is likely to change in the future. Is that we're going to probably start to reprice a few assets in the more mature cryptocurrencies.
Yeah, interesting. Okay, well, we always kind of go too fast when you're on, my friend. I mean, we're almost at a time, but you kind of pictured that global economy. It's caught between a slow motion implosion of sovereign debt and the kind of acute shocks of trade wars and those bursting asset bubbles. You recently spoke about this coming global reset. Now, of course, we've talked about this before on the show. We talk about it in depth, but for the people watching us right now on Kiko News who are trying to protect their family's wealth with tangible assets, what does that reset actually look like? And as we close, I mean, what's the single most important signal, kind of the tripwire that we should be watching for that tells us this slow motion crisis is about to go into hyperdrive?
Yeah, I think you need to pay a lot of attention to the digital euro experiment that the European Central Bank wants to implement, because that is likely to be the blueprint of what a lot of governments and central banks may try to do in order to reset the system and try to transfer the brutal amount of liabilities incurred by the government to the real economy. How to protect yourself? I think it's very, very easy and challenging at the same time. You need to invest, not thinking about the headlines created by geopolitical issues or by political news, but more about the monetary issues, because they completely overtake everything else. So invest understanding that the only thing that governments will do once they enter into this phase of currency debasement is to try to offset part of their liabilities with the wealth and the savings and the deposits of those that they can control with their currency. No, so don't invest in deposits. It's one of the things that I would say.
Yeah, well said. All right, a powerful and sobering perspective. Dr. Daniel Lacalle, of course, Chief Economist at Tressis. Thanks for your time, my friend. I appreciate it, and hopefully we'll speak to you soon, Daniel.